Hi there, everyone. Welcome to Chart This with Dave Keller. Welcome to the show here on Friday, April 25th. So glad you're joining me a little later than normal, but I appreciate your patience here from a beautifully sunny Redmond, Washington. And to be totally honest with you, the reason why I'm late, had lunch with my wife. It was a beautiful day. We walked. We had a nice long walk. I'm like, I'm going to wait a little bit. So I appreciate you being patient as I enjoy that time because it was awesome and good weather, which we're thankful for. So let's do it. And hey, let's celebrate a pretty decent week for equities out there and risk assets, with the S&P and the NASDAQ and major averages finishing this week quite strong. Strongest week in 2025, I would say, by in terms of where we're at and what we've done. The real question from here is going to be sustainability. What we'll do in today's episode, do a brief recap of some of the market action here on Friday. I'm going to save most of my analysis for over the weekend for my weekly flight plan that I produce for our Market Misbehavior Premium members. And we'll move on to some great questions we've received here in this week. We'll talk about the Zwag breadth thrust, which I had a lot of questions of in the last 24 hours, certainly been all over social media. Questions on RRG, questions on S&P targets, Coke and Pepsi, all sorts of good stuff. So let's get to the charts. First, let's look at what happened today in the markets. And pretty much all good. I mean, except for one day, which was a bit of a pullback day. The rest of the week was pretty strong here for the equity markets. The S&P finishing up about 0.75% to close at 55.25. And what's noteworthy about that close is it's above that level we've been talking about often, which is 5,500. So today's close gets us back above that level. That was the breakdown level that was so important, clearing the way to that early April low. We've now round tripped all the way back and closed above there. Now we'll get to the chart of the S&P in a moment, and I will tell you that follow through is crucial. So I think the beginning of the next week is going to be pretty important to follow. But for now, it's a pretty big win, and I think at this point, at least you have to think of this market as in a neutral positioning and no longer a clearly bearish positioning. Long term, we can still talk about all the reasons why the market could and arguably should go lower, and talk about valuations and all of that. But at the end of the day, price is what's most important. Prices have been going up, and to the point where I'm not comfortable saying this is a clear, just obvious bearish tape. I think between 5,500, between like 5,750, 5,800, at worst, it's neutral, right? We're sort of in that wait and see period tactically. NASDAQ composite even better, up 1.25%. Mid caps and small caps actually both in the red. The mid cap index was the worst performer, down about 0.4%. The VIX continuing to move lower. Now we're down around 25. So what we've talked about, this high volatility environment, the high volatility environment is getting less high vol by the day here. And we're actually pushing back toward that 20 level. VIX below 20 is a pretty low volatility, kind of comfortable market environment, right? Kind of a nice, slow and steady bullish environment is what that reading would suggest. So we will see if we get there next week. It could happen certainly by early next week at the earliest, but let's wait and see what happens. Looking at the bond markets, you can see bonds moving higher today. The TLT up 0.75%. Bond yields generally moving lower. The 10-year yield finished around 4.25. 5-year points now below 3.9%. Long bond yield getting down toward 4.7%. So you're seeing stocks up, bonds up here to finish the week. Dollar slightly higher, not much of a change from yesterday's close. Looking at the commodity space, the DBC, which is a broad commodity ETF, flat for the day. Gold and silver both down. Copper prices down. Energy prices higher, both crude oil and natural gas. So certainly this week, I mean, as I take some time over the weekend and reflect on what we learned this week, I mean, certainly quite a bit of strength, to be honest with you. And at some point, you can't label it a counter trend rally anymore. You have to acknowledge that it's enough strength that it tells you it might be something different. I think we're probably there after today's breakout above an important trend line on the S&P 500. Charts like gold and silver are still very strong charts. I don't want to draw too many long-term conclusions from a short-term down week. Gold has logged some of the best gains you'll find anywhere in 2025, so plenty of room to pull back, I would say, and still be pretty strong. My latest episode of the Market Misbehavior podcast, by the way, Jeff Hughes, we released that episode earlier today. Please watch that one. Two general areas we focused on: precious metals, particularly talked about gold and silver. Jeff had a very good call on gold going into 2024, which remains obviously one of the stronger places, but silver now one of his top ideas. We also talked about downside potential for the S&P 500 and how to get to some of those levels, looking at valuations, looking at real returns, a lot of really interesting things to think about there. Final section here is looking at cryptocurrencies. You can see Bitcoin and Ethereum, kind of a nice update. Bitcoin has been trending higher, briefly above 95,500 as we're going live here after the close, equity close on Friday, right around 95,000. So a nice breakout above resistance, continuing to show some gains. Ether prices right around 1,800, continuing to maybe rotate higher and achieve a higher high. A lot to be encouraged by, I would say, with that particular area of the financial markets. Note the split performance, though, with the sectors, right? So you have the FANG sectors doing very well today. The XLY, XLK, and XLC all in the green. Consumer discretionary, your top performer. Tesla had a banger of a bullish day today, up 1.8%. Technology up 1.5%. Comm services, number 3, up 0.6%. You had healthcare up, but then everything else was flat to down. You have materials, financials, utilities at the bottom of the list today. So while it certainly was a good day, and I would say the strength in some of those growth sectors really helped propel the market higher, the breadth on a day like today in terms of the actual performance of stocks was not particularly good. You can see here, looking at the advancers, decliners, kind of neutral, right? That's the color coding on this visualization now. Neutral is kind of like really close to 50. And then obviously coloring extremes, bullish and bearish to extreme bullish and bearish readings. This is still sort of within the neutral category, right? Look at the NASDAQ composite, almost dead even between stocks up and stocks down. The New York Composite Index, more up than down, but not by much. The S&P 500, 60% of the S&P members were down today versus 40% up. So while it was a good day and a strong finish to the week in terms of the performance of the benchmarks, underneath the hood, not as strong of a day as we've seen previously this week, right? We've seen other days where 90% up day kind of moves. Today, not really that way. Here's Tesla up 10%. That's a pretty decent finish to this week. That stock is starting to really break out of that neutral range that we've been talking about. We'll see if there's enough momentum to clear that range next week, but a nice finish to the week, up 25 points today. NVIDIA up over 4%. That helps as well. On the downside, Netflix, which has been arguably the strongest of these stocks by far, still up, but not by much, about 0.4%. Same for Apple, which still, I would argue, from a technical perspective, has more to prove. Now, all of this action looks like it will mean our short-term market trend model actually finishes bullish. We'll see when the closing data is all logged and confirmed this weekend. We'll dig into that a little further with our premium members at Market Misbehavior, but it looks highly likely that the short-term model turned bullish, medium-term model remains bearish, long-term model remains bullish. So my model is telling me this is still a tactical rally within a cyclical bearish phase. That medium-term model, what's most important for me to look for an upside rotation. Not seeing it yet. That is a brief update. I want to look at a chart or two, and then we'll get to some of the really good questions we've received here. And, daily chart of the S&P 500, what's important here is today we're cleared 5,500, which takes us back above that Fibonacci level we highlighted and watched so closely in the month of March, and that breakdown was so meaningful. We're now all the way back up there and breaking above this thick purple trend line we've had on our charts here for a month or so. That's pretty encouraging, right? I mean, it's not a bad thing. The momentum still has more to prove. The RSI is still not particularly high, given how much of a run we've had. I would still say there's a lot of moving average resistance above where we're at. So I think there's upside to be had up until that range now. But let's see if we have follow through going into next week. The market carpet, how we finish the week. There's NVIDIA with a really good update. Where'd Tesla go? Oh, here we go. Tesla with a nice 10% up day. You can see in communication services, sort of some of the larger names had really good days. Palantir almost 5% higher. So those are nice finishes. But if you look at today, sort of ignore those big growth names that did quite well. This was not a particularly strong day, right? It's charts like T-Mobile, arguably a really compelling chart going into this week, threatening a new all-time high, down 11% on earnings going into the weekend. Some of the other old school telecoms like AT&T, Verizon, also with big mobile operations these days, also in the red. A lot of kind of neutral to red outside of those mega cap growth names. So if there's anything that's not great about how the week finished, it was sort of the broad advance we saw into Friday was not completed on Friday. It was sort of a lighter breadth day. Enough of the biggest names did well to push the benchmarks higher, but the broad advance, which we've seen for days earlier this week, really not matched with today's rally. All right, shall we take some questions? And again, I want to thank you guys so much for sending in some really thoughtful questions through the course of this week. These all came from people like you dropping questions during the live stream and or putting them on the comment section of our YouTube channel, and I appreciate all that very much. Question number one, I received many versions of this question, so I'll paraphrase all of them by saying, did we get a valid Zwag breadth thrust signal this week? And the short answer is it's not particularly clear is how I would describe this. I've got a pretty good network of technical analysts. Some of them are peers where we kind of, entered the industry around the same time. And a lot of them have had really good careers on the sell side, on the buy side. I have mentors that I've learned from years ago that I was able to connect with. I've got younger analysts whose work I follow to see what we're all seeing. It sort of depends on how you measure the indicator. I'll show you the version of the indicator that I use, which is on stock charts, which actually did register a buy signal from the Zwag breadth thrust. But I'll explain why, depending on how you measure it, it wasn't. So here is what is known as the Zwag breadth thrust. This is an indicator named after Marty Zwag, based on his work years ago. Back in the day, Marty Zwag was a legendary analyst with market moving potential, right? He would make a comment, it would be reported in the news, markets would move because of things he was saying and analyzing. That's a bygone era, but a pretty cool era to think about and learn about. And again, others who came before me were actively investing during that Zwag era, and that was pretty cool to hear some stories along the way here. But his essential observation is really about what a breadth thrust means, and a breadth thrust is very simply the market's going down, you have really negative breadth, and then in a very short period of time, you have a bunch of positive breadth. So the breadth swings, the pendulum swings very quickly from really bad breadth to really good breadth. And so his observation was before big advances, you often have what's called a breadth thrust, where the breadth goes from very negative to very positive in a very short period of time. Now, the issue right now is how you actually measure it. I can show you what Marty Zwag was supposedly doing when he originally created the indicator, and how that indicator has been adapted, why the stock charts version fired, and some others I've looked at and talked to, people I've talked to would say it did not fire this week. So this vertical line highlights for the last 25 years, every time you've had a valid Zwag breadth thrust buy signal. And if you look at what happened in the months and after those signals, you can see why people are understandably pretty excited, because most of the time, I mean, barring this one observation in late 2015 where we went higher for like a month before making another top and making a new low into early 2016, pretty much all the other observations were pretty decent uptrends soon after. I mean, this is another one like in 2004 where we rallied a little bit and then made a new low before embarking on a great bull market. But I mean, most of these happen before really solid advances. And that's why people are so keen on looking at this breadth thrust. I'll zoom into the most recent signal just so you can see what it's actually looking at. So the indicator is based on the advancers in the New York Stock Exchange versus the total listings. And so right off there, it depends on the data source you use and how it's calculated and what you consider to be included in the number. You can have different observations. And then what stock charts uses is a 10-day exponential moving average of that indicator. And if it goes from below 0.4 to above 0.62 within 10 trading days, the Zwag breadth thrust is considered firing. So again, you have to start below 0.4, 0.4, and that's a 10-day EMA, exponential moving average, of the percent of advancers versus the total listings on the NYSE. So you have to go from below 0.4 to above 0.62 within 2 weeks, within 10 trading days. And if so, that's considered a buy signal. And so the indicator, if you look, is exclamation point BINYBTD. And I'll try to remember, although I'm not good at remembering this kind of thing, to include a link to this chart if you want to save it to your own stock charts login, those of you that are stock charts members. But this chart basically just is a binary signal. It sits at 0 most of the time, and then will go to 1 if it generates a signal. And that's so you can overlay it over the price action using this methodology, and then have a signal when it actually fires. So the fact that the breadth was pretty bad and then was very good very quickly. Now, some people, and Zwag's original work actually used a simple moving average. And if you use that, it may not have fired, again, depending on how you do it. Exponential averages are a better way of recognizing those shifts, which is why it's what's used on stock charts, and that's what others may or may not use. So you might have heard a lot of discussion and debate from technical analysts about whether or not it fired, and that's because depending on your data source, depending on how you calculate it, and depending on what you consider the signals, there's just a lot of fluidity. There's a lot of differences of opinion about what the right way is to do it. So I default to this version, and it did indeed fire. So what does that mean? Usually means we're in a pretty good position. That rarely fires, although it has fired where you have limited upside and then another low. And it's not perfect, but most of the time after this signal, the next 3 to 6 months are actually pretty bullish. So that's the short answer on the Zwag breadth thrust. I'm noting to myself, I should probably make one of those YouTube videos at some point on this so I can have something to refer people back to, because it's a pretty cool indicator. And again, may have recently fired this week. Next question, and this is after the YouTube video we did earlier this week about the RRG chart. It might have been last week's video looking at the relative rotation graphs. Clearest explanation of RRG I've seen. Do you ever use $1 rather than $SPY as the reference point? If so, why? I'll refer you back, and I'm getting a bunch of lists. I'm coming up with mental things to link in the description. But I will link to Julius de Kempener's interview on my Market Misbehavior podcast, because I think we talked about this particular question. Briefly, I want to say in that interview, that the last time I had it on, but I have talked with Julius many times about that. What you're asking about, and if you didn't watch that video, number one, everyone should go watch it, because I hope it was pretty helpful. Just talking about different takeaways of looking at this visualization of sector rotation. And what you're talking about is when you have an RRG like this, these are the 11 S&P sectors kind of rotating around the benchmark in the middle. And what you're asking is the benchmark is the S&P 500. That's what's right here. Now, another thing you can do is you can actually say $1. So why does this give us a totally different thing? So the idea with the RRG and what Julius de Kempener's, I think, brilliant I guess, light bulb moment was thinking, all right, the way that I can visualize sector rotation is put the S&P in the middle and then use some statistical, analysis of relative performance to show how the sectors are rotating around that benchmark. And so the benchmark's in the middle, and then I'm looking at things, how things are outperforming, lightening up, underperforming, starting to improve, and you can see how things rotate. And the calculations of these two proprietary indicators are what turn the relative strength data into this beautiful scatter plot that shows the sector rotation that you kind of assume that's how it plays out. And it really was. It's called relative rotation graphs because it's built on relative performance. It was originally designed primarily for institutional investors whose main goal in life is to outperform a benchmark. So you put your benchmark in the middle and you want to find things that are outperforming your benchmark. Now, what happens when you do this, $1 basically just turns this into absolute returns. So instead of seeing the S&P 500 in the middle, you basically have a neutral position in the middle. You have cash in the middle, and you're looking at where these sectors are rotating around that sort of cash position. So there's 0, and then we can see that certain sectors were actually going up on an absolute basis. But now you can see that most of the S&P sectors using the weekly data that I'm showing here are going down on an absolute basis and are actually trending downwards. So instead of applying this proprietary visualization to relative data, it's on absolute returns. So why would you actually use this? I do use this occasionally. I most of the time keep it to the S&P 500 because I have plenty of things to help me analyze the absolute returns of different things. This particular visualization, I think, is so beneficial at helping you understand the relative story, which is why it's such a great way to add to what you're analyzing on some of these individual price charts. But it can be helpful to switch it to this to look at absolute returns, because a lot of times looking at the relative rotations doesn't really help you understand whether these sectors are actually gaining or losing value, because it's all relative to a benchmark. So by switching back and forth, you can understand which of these sectors are actually going up, are actually gaining in value. Okay, let me look at the relative story. There may be things that are actually losing value but are going down less than the S&P, and they're still kind of good bets. And so I think using both of them in an appropriate way, in an intentional way, can be quite helpful. I'll point you to the interview with Julius de Kempener. You can get his. I mean, he designed it, so he's got a better take than I do probably about how and why you should use that. But I found it's really helpful, particularly when you're looking at like the members of a sector. So if you go here on stock charts to group and pick like XLY members, here we're looking at the consumer discretionary stocks relative to the consumer discretionary sector. But if I do this, I'm doing the consumer discretionary stocks versus cash. So it's looking at the absolute returns. You get a very different story, because a lot of these names, most of these names are actually going down. But when you do it relative to the sector, it helps you see which ones are doing better or worse than the sector ETF. So both of them have value, I think, depending on what questions you're really trying to answer. Great question there. And let's continue on here. Is there a bottom signal that you would consider to be the mirror image of the Hindenburg omen, only signaling a bottoming rather than a topping pattern? It's another question I've gotten in some form a lot of times after the February market peak. Once it becomes clear we're going down, and the Hindenburg omen was brilliant signal. When I think of the last 12 months, that's been one of my, most helpful periods, and just, the fact that the Hindenburg omen fired when it did sort of told you early 2025 was going to be painful, and it kind of was. That was really, really valuable. So is there something that would tell you the opposite, that something's a good, the market may be bottoming out? So kind of, right? I mean, the Hindenburg omen on itself, it does not have its own sort of buy version. That indicator specifically was created by analyzing major market tops. So what do you do as a bottoming pattern? I mean, the Kopik curve is the most obvious sort of parallel to that, kind of a bullish parallel. The Kopik curve, what that is, it's the bottom indicator here. This is using a monthly chart of the New York Composite Index. And the Kopik curve is named after an analyst named Sedge Kopik. Many decades ago, created this as a way of. He actually talked about it as being based on a mourning period, like how long the market needs to be in a period of mourning during a bear market phase. Right, the market's sort of depressed; it's in mourn. How long does it take for the price to recover? And so the Kopik curve literally looks at the difference between the 11 and 14 month moving averages. This indicator is sloping down, usually in a downtrend, and then eventually it starts to slope higher. And when it starts to slope higher, it suggests that the mourning period is now over, and we're entering into more of a period of optimism. And you can see it's a pretty good indicator to follow, particularly after a major low may have been established. Because it really tells you that whatever was happening is probably getting better. Now, the problem with the Kopik curve now is it hasn't even gotten below the zero level. And you can see all these other kind of quote unquote buy signals I'm highlighting. We were in a downtrend for long enough that it actually turned higher. So you can see, like, with the COVID low, it took quite a while for it to turn back positive, because it was skewed negative for quite some time. So I don't know if I would be looking at this right now for a buy signal, because the downtrend was not long enough and significant enough, because you can see, like, this pullback. I mean, we're not looking at like a 50% sell-off like during the great financial crisis, where it's like the market's obvious in a mourning period. When is it going to be over? That's when I think to use the Kopik curve. With where we're at now, it just hasn't been enough of a sell-off to really register that. But I would say that's probably the most obvious kind of counterpoint to the Hindenburg omen would be the Kopik curve. I promise I will dust this chart off and start making noise about it if and when it is appropriate to watch it. I'd probably say just not quite there yet. All right, we'll continue on with the next couple charts here in a minute, and great questions that we received. As a reminder, we have a recommended reading list. So if you're looking to upgrade your thinking about the markets, you want to improve your technical analysis toolkit, and personal development, make better routines, better habits, all of those things, my recommended reading list is on my website. You can go to marketmisbehavior.com/reading list, or just scan the QR code that you see on your screen. Great books, all that I've read, all that I would recommend, that have helped me in different areas of my professional and personal lives. and I hope you find them great things to gift to yourself or to others whenever appropriate. All right, let's keep going here. Next question. Do you still think the S&P ends up at 4,500? And if so, what's your game plan for getting back in between now and then? It's a really good question. That is the question, I would say. And I will tell you, there are times, having done this for a couple years, I will tell you there are times when things seem very straightforward. Like bull markets of 2021, 2024 are probably the most obvious examples of that. Like you can come up with some reasons why the market should go down, but it's like, but the trends are so clearly positive. Pullbacks tend to be short-lived. There's just a lot of good stocks doing good things, and it's just hard to be anything but pretty constructive here. Then there are times when it's so obviously bearish, like the financial crisis, and we're debating like, will the equity market survive kind of questions. And it's so obviously bad that I feel like if you're bullish in that environment, you're just ignoring clear negative evidence. This is one of those weird times. And there are people that I respect and whose work I followed for many years that are very bullish right now. And I had Craig Johnson on my podcast in the month of April. He was talking about how the April low was it. And that we're going to go and make a new high from here. I mean, so far, that's looking like a pretty decent call. I just had Jeff Hughes on my show yesterday, who had the complete opposite take and said, this is a counter trend bounce. We're going to make new lows. And here's the downside projection. And it's pretty low. And again, at times, both of them have had really good calls and really good takes on clear evidence. I would say this is one of those times where the evidence is very mixed. And there are people whose work I follow and whose work I think is very good, who are very optimistic, and there are others who are very pessimistic, and so it's a very confusing time. And I would say the incredible volatility makes it very hard to project future cash flows if you're doing a DCF model or something like that. If you're a fundamental analyst, the fact that the target is moving so much makes it very, very difficult. How tariffs impact a company's ability to grow earnings. We talk about a big unknown. It's a huge unknown. So I think it's very, very hard to do what you do as an investor, as a strategist in this particular environment, because it's a noisy kind of a difficult to read environment. And there's just so many things that could cause prices to go up or go down. So your question was, do I think we still see 4,500? At this point, I think that's still my general perspective. I would say if and when we do get to 4,500, you will hear me talking about a fantastic buying opportunity, because I would think the long-term potential of this market is still very good. I think short-term disruption is what we haven't had enough of, and probably what we need more of. And certainly given the uncertainty, I think valuations are still very high for what would normally happen during a corrective period. So I think we probably will. Which means I'm probably, looking for a peak that leads to the next leg lower here, or maybe the next big headline that causes that. I would say at some point you have to throw in the towel on a very bearish perspective and say, look, the market's just not going down anymore. I think the 200-day moving average, sort of this range, is what does it for me. I think anything below that is still, you can still think of that as yet to be proven. But the S&P pushing above the 200, like, it's really hard to not be more constructive at that point. I think you'd be missing, what's clearly a rally phase at that point. So for now, that's kind of how I think of it. I actually just wrote an article which should be posted on the Stock Charts platform already, looking at a certain way to think about that. I'll see if that's true. Go to stockcharts.com, go to articles. There we go. S&P rises from bearish to neutral, but will it last? I'll refer you to that beautifully written article by myself about an hour ago, because I think that'll answer your question in a little more detail. All right, next question, 2 more, and then we'll call it a week here. Given that Pepsi and Coca-Cola are in the same sector and industry, is it odd that they seem to be trending in opposite directions? I love this question so much, and that could be a day-long, retreat as we talk about different ways to think about market analysis, right? And as an equity investor, what you have to remember is there's the broad market forces, right? So generally, are people adding risk or taking risk out of their portfolio? There's the sector level. What sectors tend to do well or tend to do poorly in different market regimes? But then there's like the group level and the stock level, which is, are beverages a good play right now? So with Coke and Pepsi, their movement is part of that entire story, right? Part of that could be a broad story of whether or not people are just adding risk or not. It could be whether consumer staples are a place where people are focusing their attention. Could be beverages in particular, and what things like tariffs mean for, their businesses going forward. And then when you get to Coke versus Pepsi and sort of a cola wars discussion, there are a lot of places where you see that, like Home Depot and Lowe's, right? Home Depot and Lowe's could do well because people are, doing more home improvement. So they need more lumber and tools and stuff, which means probably good for both of them. But Home Depot and Lowe's are not the same company, and they have different businesses in some senses, and they have different strengths and weaknesses and different things, different suppliers. And that means like things could be better or worse for one company versus the other. And I think, to get to your point, this is one of those times when Coke and Pepsi are not the same chart, right? Here's the chart of Coke, and I'll focus your attention particularly on the year-to-date returns. Here's 2025 for Coke, and here's 2025 for Pepsi. And I have this chart that I've created called Compare Two Stocks, just so I can put Pepsi in one and I can put Coke in the bottom, and you can quickly see the fact that one of these is going down over the last 6 months, and one of them is definitely not. And Pepsi is the one going down, making a new 52-week low today. And Coke is making a new 52-week high, I think on Monday of this week or Friday of last week. So one of these is clearly winning the cola wars in 2025. So what is that? I mean, so what this tells me is that the move that you're seeing in 2025 is less a sector play. This has less to do with whether people are adding to consumer staples, and it has more to do with something going on with these individual companies, which you have to remember, their valuations are different. Their dividends are different, although both of them are fairly consistent dividend payers for many, many years. I mean, decades, they've been paying a fairly consistent dividend. So I don't think that's the real differentiator. When you think of Pepsi, it's a lot of other brands, right? So Pepsi, you've got, oh man, I shouldn't have opened my mouth on this because I have to come up with different brands. But I mean, Coke you think of as fairly beverage oriented, right? Coke has things like, they have some alcohol in there, right? Like Jack Daniels is a Coke product. Juices, sports drinks are all part of Coke. But when you get to Pepsi, you're talking about like snack foods and Frito-Lay. Quaker, which is like oatmeal and snack foods, is part of Pepsi. So Pepsi actually owns a bunch of other things like snack food things. So I mean, things like people tend to be eating healthier these days, probably not helping Pepsi's, snack brands. Like, I don't know if corn chips are a great growth area at the moment. So I think there are subtle company differences between the two. Now, again, I'm not a fundamental analyst covering beverages, and they would probably have a much more eloquent way of just describing it. I tend to simplify as much as possible. I would say this is the types of companies and brands that are part of that Coke family appear to be doing better. That's part of it. It could be something about tariff expectations. I haven't dug into those stories much to think about whether Pepsi would have like more exposure and then Coke, which is why there's a big differentiator there. That could be part of the story as well. I would want to dig deeper into that, but this is one of those times where it really is a company specific issue, and one of these is a better chart than the other. This is why I think, being too simple and saying defensive stocks are good, I should buy beverages, I should buy Pepsi because it's a beverage company, you're missing your ability to say, all right, within beverages, which charts are really good right now? And one of these looks a lot better than the other. I'd probably want to own the better one. What's so funny, though, by the way, if you look back, because I did look back when I saw your question, look back at articles at the end of 2024, most of the articles I read were talking about Pepsi as a much better play because of valuations, because Coke was a higher valuation. Talk about a bad reason to buy one stock versus the other is my very biased way of answering that question. All right, final one, and then we'll call it a week on Chart This with Dave Keller. Can you talk more about the 12-1 approach by the institutional investors? Never heard of that phrase. I dropped this earlier. I forget what, if this was during the webcast this week or where I remember seeing this question. I wanted to highlight it for all of you because I did get some questions after I mentioned at some point a 12-1 approach. So let's look at Kroger, which is one of those kind of nice, slow and steady gainers here over the last 12 to 18 months. Institutional quant models, right? A quant model or an alpha model is basically a way of looking at characteristics of good companies, good stocks, and looking at thousands of stocks and just kind of scoring them based on these different factors. So the momentum factor, how strong is the price action? The volatility factor, how volatile is the stock? the size factor, how big is the company, value, where is it at in terms of valuations. Basically, you have these different ways of describing different companies and different stocks, and then you rank the stocks based on how they score, and that gives you a percentile ranking or some way that you weight those factors, and you can come up with like a composite score. And this is what like Investors Business Daily does with their IBD composite score. This is what a lot of other, the Seeking Alpha Quant model, which I've spent a lot of time with in recent years, does a similar thing, looking at fundamental and technical factors and coming up with sort of a master ranking, a quant score based on those factors. So the particular factor that you're talking about is called the momentum factor, and there are different ways to score stocks based on momentum. Common ways are simple return. So what's the 12-month return or the 6-month return, which literally means where is it at now? Where was it at 6 or 12 or whatever look back period you have? And you score stocks based on their percent returns over that look back period. That's a very simplistic way of doing it. A more nuanced but arguably better way is to do 12 minus 1. So what you basically do is look at the last 12 months of returns, and you either ignore the most recent month or you take them, you subtract the 1 month return. So basically the best score would be a stock that's had a strong 12 months and then it's had a weak 1 month. Now, why would you do that? Because you're looking for this. We at Fidelity, we used to call this a fat pitch chart. We're in baseball season. A fat pitch is like one of those balls right over the plate. You have to take a swing at it because it's just a great setup, a great pitch. 12 minus 1 means a strong 12-month period, but a pullback. And for institutional money managers, if you run a big fund, you're always worried about buying into a strong tape because your buy orders will actually create further demand because you're trying to accumulate so much of it. And so you'll literally cause the price to be more and more elevated, and you'll create a higher price for yourself. So what you try to do is buy into weakness so that you don't shock the market with a bunch of buy orders and that you're able to get filled a little more easily. And so you look for weak 1 month returns, which means you're getting in at a pullback. So it's basically a way to automate or systematize a buy on the dip strategy. Strong long-term trend, weak pullback. So when we talk about stocks pulling back to an ascending 50-day moving average, we're kind of doing a subjective technical version of that 12 minus 1 portfolio. And so a lot of quantitative models, alpha models, will have that as the momentum factor. And that's a way of just scoring how close is this price chart to kind of my ideal entry point, which is a brief pullback within an uptrend. If you look at Google momentum factor, you'll probably find something. Google momentum factor 12 minus 1. I've not done this, but I'm hoping that someone has written a really eloquent paper that sort of describes what I did in a lot more detail with back tests and stuff. And if not, maybe it's something I'll hope someone writes very, very soon. That'll do it, folks. Fun as always. I mean, really thoughtful questions, and I can't tell you how much I appreciate these questions that come in during the course of our show. Week in, week out. It's a pleasure to do the shows, pleasure to recap the markets, try to give you some context, give you some perspective and ideas about how I'm positioned and what I'm looking for. I hope this helps enhance your understanding about the markets and improves your own situational awareness. Have a fantastic weekend. Hopefully you have good weather where you're at, like we do here in the Seattle area. Enjoy it. We'll be back with a normal broadcast schedule next week. In the meantime, remember, it's always a good time to own good charts. Have a good weekend, folks.